Philip Morris International's main cigarette business is slowly dying, but the tobacco giant isn't going gently into the night. The company just announced 2 deals that will keep it healthy in the years to come. The past decade hasn't been kind to the tobacco business. The number of traditional cigarettes smoked globally dropped from 5.23 billion at the start of 2018 to an estimated 4.69 billion 5 years later, even as companies raised prices to compensate for fewer packs sold. Even without the burden of a U.S. cigarette business that's been Altria Group's problem, Philip Morris stock, PM, has suffered. Philip Morris, though, is a different company than it was just a few months ago. Its November acquisition of Swedish Match further cements its global leadership in oral nicotine and adds to its portfolio of what it calls reduced-risk products, which don't require users to burn tobacco. That deal closed a month after it paid Altria $2.7 billion for the rights to sell Philip Morris's flagship IQOS product in the U.S., marking PM's first return to the domestic market since the two companies split in 2008. Together, the deals mean Philip Morris could have a longer, brighter future than many investors had feared. They are further proof that Philip Morris is on a path to be a durable, profitable, and growing business for a very long time to come, says Brian Engler, a portfolio manager at Kovitz Investment Group Partners. With global cigarette sales falling steadily over the past decade, Philip Morris isn't the only company branching out. E-cigarette sales alone ballooned nearly sevenfold, to $2.1 billion, from 2015 to 2018, the year that Altria made a $12.8 billion investment in vaping company Juul. Critics charge that smoke-free tobaccos are still carcinogenic and that vaping might pose health risks. Yet even the Food and Drug Administration acknowledges that some tobacco products, including IQOS, reduce the production of harmful chemicals, compared with combustible cigarettes. Philip Morris is betting on being the lesser evil. By 2025, the company wants over half of its sales to come from smoke-free products, and the string of recent moves makes that goal more reachable. Philip Morris's RRP business grew 33.5% in 2021, to more than $9 billion, or 29% of sales, up from just over 13% in 2017. IQOS, expected 2024 U.S. relaunch should offer some stabilizing dollar-denominated sales to offset foreign exchange risk, while giving it access to one of the most profitable nicotine markets in the world. Wall Street expects Philip Morris to return to record per-share profits of $6.68 in 2025. Profit margins should widen, too, given that the most intensive spending on development and marketing is largely in the past. Gross margins already jumped to 68.8% in 2021, above the company's 5-year average of 65.5%. Some of these advantages are already reflected in Philip Morris stock. At 17.7 times 2023 earnings, it's trading above its own 5-year average of 15.4 times, and higher than Altria, British American Tobacco, and Japan Tobacco, 2914. Japan, which fetch 9, 8.4, and 10.4 times, respectively. Still, the Philip Morris is cheap, compared with other consumer staples stocks, including Procter & Gamble, PG, Coca-Cola, Co., and PepsiCo, Pep, which fetch around 25 times, even as Philip Morris boasts higher gross margins. At a recent $103.49, its stock looks like a buy.